Hello, everybody. Welcome to Afternoon Outlook with a completely blank screen behind me. D.R Barton Jr. coming to you here, and we have just found out that indeed looks like our charting package has completely jammed up just when I switched over and put in a few different names. So I'm going to be killing that and restarting it for you in real time. Not very exciting, but I have some other things to throw up and show you while we're looking at this. So if you'll bear with me 1 minute, I've got to kill a few things. Stop that. And we are going to talk about a whole bunch of interesting stuff. Let's start with that while I'm doing this. Let's pull up, there you go. We are going to be looking at some data on coronavirus in just a minute. But first, let's look at what we're going to talk about today. That would be a good thing to look at. So in order to do that, I'm going to jump out of your way down here. Then I'll remember to jump over here and when we get to charts. So I'll be out of your way. But let's start over. Let's not go to that particular background. Let's do this. Let's get me out of your way so we can talk about today. And here is what we want to talk about. The big thing is that there is a huge reality gap in the markets between where we are and what's going on in the real world, those 3-century or half-century long extremes. And I want to talk to you about that. But first, I am going to pull up our chart, get this over here so I can look at our chat for a couple of minutes because I have it in here. And I am going to make sure that we're on, that we're live, that I'm refreshed, and that I could see your nice face. Give it a refresh. We're out there now. Frozen. We are moving loud and clear. Thank you, Greg. Good deal. Let me see who is everybody out there. Hey, Serge, Dark Edge Project guy. Glad you're here. Did you reel in a couple of those trades today, Sergio, when we were for T-Mobile or for Slack? Let me know in the chat room. I'll see you good. I'm glad people are here from New Zealand. Alex, glad you're here. Thanks so much. Kansas City, all those folks. Okay, here's what we are going to be talking about. So we're going to hit these 3 either 100-year or 50-year extremes. Going to talk about that, and yet the markets are making new, recent near-term highs. But we've got to look in at our COVID data today. It's very important because there are reasons for both concern and optimism. We'll talk a little bit about that, and we'll also talk about some COVID fallout. I have a very interesting thing that's coming up. Reuters had a report on it today that we'll talk about that may impact us, and we're going to look at 2 different markets there. We'll look at both the Emerging Market Index, EEM, the Emerging Market ETF, and we'll look at one that you may not be as familiar with, the Frontier Market ETF. So we'll talk about both of those. We'll once again dig into the charts, see what we've got going on there, what's important for us to look at, know, and understand about our levels and what could be happening going forward. And lastly, I have a couple of stocks for you to look at. I think you'll enjoy those. I'm pulling up my sheet. And there's one of them that's a play one way or play the other that I know some of you more advanced traders are going to really dig. So with all of that said, and I still have to do a little bit of, I've still got to do a little bit of house cleaning. Let's clear this up. Let me get over here. You'll have to bear with me while I look down here for just a minute because I've got to get some things here shut down in order to start back up. We had if you weren't here at the beginning of the broadcast, we had a trading system completely lock up on me. I was pulling up these trades I wanted to tell you about, was running through those, and my TradeStation platform just completely lock, stock, and barrel locked up. So that should finish getting that. Let's pull it up. I'm ready to go. Yes, do that, please. And there we go. So let us get this thing going. All right, with really good fortune, and it's not that, we know this stuff works. this will be up and running for us in just a minute. So now let us talk about, well, it's going to keep rebounding back to this while it starts, but that's okay because we have some stuff to look at. And let me pull this down first. And one of the pieces of news that we want to talk about, I want to talk to you about these three century-long extremes. Let's do a little chalk talk. I'll go to the chalk on the board here, and let's look at three different things. I'm gonna even change colors here. Let's look at three different things. Number one, this one you already know, the COVID-19. The COVID-19 and the pandemic is the biggest health disruptor. This is the biggest health disruptor of the last 100 years. We've had nothing like it since the Spanish flu globally. Now, we've had some pockets of things. We've even had a couple of things that were called pandemics. But we have never had anything that was as pervasive and as deadly and as economically crippling as we've had with this disease that's going on now, with this virus that we continue to fight. The second thing that's happening out there is, as you know, we had the new issues with the China discord between the China and the U.S., but this time it's also China versus Europe, China versus Australia, and the list goes on. So I don't even know if that Australia, so we probably, to keep from being Austria, let's just write it out in case any of our Austrian audience would take umbrage there. But so much going on there that are huge ramifications that are happening. And the third one, following the tragic and very public and very wrong death of George Floyd, we're seeing biggest civil unrest that we've had in the United States in the last 50 years. Let's call it 52 years. We haven't seen this widespread of unrest in our country since the Martin Luther King assassination in 1968. It's disruptive, it's disturbing, and my hopes and prayers are that we come out of this with a new, real dialogue to make real change in what's happening in our country. And this isn't just about a racial divide, it's about an income divide. If you look at what's happening in these riots, there are people of every race, creed, and color out there who are feeling disenfranchised by the systems and the way the systems are in place. We will have to move forward to make some major changes in how we do things in the United States. And I'm looking forward to this transitioning into a peaceful and meaningful discussion so that we can make some real change to help people that are on the side of the economic divide that feel so disenfranchised that they would go out and do this. And it's not just about economics, it's about social, it's about justice and injustice, and we hope and pray that we'll move forward as a country with this and move away from violence and other means of getting to the table. So there, we have that going on. Let me see that we finally have our chart back up here, and Afria, we have a cannabis stock up here, but that's okay because we're going to talk about some other things before we get there. So there are some extremes. The other extreme that I was talking about was the recession, the biggest one in many things. So we talked about the biggest health extreme, the biggest civil for 100 years since the Spanish flu, the biggest recession extreme. The biggest civil unrest extreme for 50 years, 52 years, and the biggest economic extreme by many measures. Let's pull up our INX here. By many measures, we've had the biggest extreme. We had the fastest 30% down ever in the history of the U.S. stock markets, the fastest 30% recovery in the U.S. stock market history. But we've also had the biggest, the quickest recession, the worst retail sales. We've had many other things, and recession loosely because economists would say, well, you have to have 2 straight quarters of GDP drop. I get that. We won't see that for another quarter. But what we have seen is the biggest unemployment numbers, the biggest GDP individual drop that we've seen, all of these things, the biggest retail sales drop. I mean, we could go on and on. So that is at clearly 100-year extreme, things we haven't seen since the 20s, and some even worse than we saw in the 20s and early 30s. So with all of those things going on, the market should be down, right? We have new things coming on. We have riots and violence and things going on with in the United States that was certainly disruptive. But look, the markets are up today. They're up 0.5%, even though they started down a bit. So that is the big reality gap between what's happening in the world and what's going on here. And you all already know the answer to why it is our narrative teeter-totter that we've been talking about for months. And that is over here we have CV19, the health and economic effects of CV19. And now we can also throw in China weighing over here. The China relations, not just trade relations, but diplomatic and political relations with China that are on the line because of Hong Kong, because of China's all of a sudden aggressiveness again toward Taiwan. And toward Australia, toward others. So we look at that, and we have all of that weighing over here, along with the civil unrest that we just talked about. We have all of that weighing over here, and over here, the only thing that's pushing down is trillions and trillions and trillions of dollars of monetary and fiscal stimulus. Right now, it's very, very clear that it's the stimulus that's winning the game, and we can see that in our market. Let's tick this down. Let's tick this down to a quick 5-minute chart, and we'll put up the spiders so we can see pre-market and see what's happened in the market today. Won't be a surprise to any of you who've been watching what's going on. We opened today actually down, as one might expect after more China news over the weekend, after all of the growing demonstrations, protests, and riots and violence. You would expect things to go down, and they kept going down right off the open. Then, lo and behold, the rest of the morning they grew right up until here. We're still down a good bit right up at the open, and then, boom, the market says we're shrugging that off, and we're heading higher. Now, there's a couple of things to learn from this one diagram today with all the negatives going on in the market. And we'll look at one more that's still quite a bit negative, and that's our COVID charts. There's something to learn from this, and that is the power, the very big, huge power of narrative. If we don't understand what's going on in the broader world, we can't position ourselves properly for our portfolio, for our long-term nest egg, or for our trading. And right now, despite the biggest guns, century-long extremes that are hitting the markets, it's still going, we're going up. And we have to, with our money, not with our social conscience, not with our political conscience, not with our health needs. We can put all those over to one side and say, but with our money, we have to respect what the market's doing, and we have to stay on the right side of the narrative. And the narrative right now is we're going up until further notice. And I'm going to give you those levels that we're going to have to look at if and when there is a pullback. But for now, the market is heading up. Now, let's talk about a couple of other things. We got a lot of things to talk about, and I've been rambling on, haven't even been able to look at your comments. We got a bunch of them out there. Okay, doing things, giving it a refresh. Okay, not much new. That's all good. Let's talk about a few different things that I want us to look at here from a news perspective. Number one is we have to look and see what's been going on in the world of COVID. So here are the most recent numbers. Now, the New York Times has really good charts that I like a lot. But they also have some things they've been putting up. They don't have a paywall, but they've been requiring a subscription. So if I refresh something and it changes here, I might have to go offline up to the side and log in. but let's see if we can get this going while we have it in front of us. And here's global tracking. If we look here, you can see the new cases on Saturday. So these are all reported last night. So a day before, the total number of cases is still globally going up. And you can see yesterday was a Sunday. So the reporting, we can see, you can tell where the Sundays or Mondays are everywhere here. Every time you get a low, here, 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 that's weekend reporting. The weekend reporting is just not as strong as all the other reporting. We've talked about that. But the total new global cases, with the unfortunate continued outbreak in Brazil, Russia, India, the countries I warned you about, India, Bangladesh, Pakistan, are all those very populous countries with huge densities in their cities, are starting to have the virus spread there. Even with testing that is lacking, we can see the growing numbers. Now, are there some bright spots? Yes, there are. Let's look in the United States. Our map is starting to go down. But the German, Spanish, Italian, almost all the maps in Europe, almost all the cases in Europe are showing a steep decline. The U.S., the concern is not so, whoa, big dot, not such a steep decline. As a matter of fact, if you look from here over, it's not much of a decline at all, a little one. And so while the curve is flattening, it's not yet decreasing very quickly. That is the concern. The good news is that, and here's all the countries where, all the states where it's still increasing. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 different states, including Puerto Rico, that it is still increasing. Here are the flat states, but some of the biggest states, the good news is some of the biggest states like New York, New Jersey, that had large amounts of cases, Illinois, Massachusetts, some of the leaders early on where we saw a lot of the cases, we do see declining numbers, and that's good. We have not yet, as I told you in the past, have not yet seen those surge numbers. What's going to happen after the reopening? Are we going to see a resurgence of new cases, ergo a surge, or are we going to continue to reopen things safely? Still watching for that. I still think we have about 2 weeks before we'll have very definitive news on whether or not the reopenings are going as planned or whether big adjustments need to be made. And until that time, the market charts that we've seen are going to keep going up. Now, let's talk about one of those things that I wanted to give you a news piece. I told you we had that. We'll give you a news piece that'll lead to an actual third trade idea that I want you to think about. And here is that news piece. If I can pull up, there we go. Let me pull up, let me find this news piece for you. And we will throw that over. Let's see here. There we go. All right. 2 different things to look at. One is this truly intriguing story from Reuters about money flow, and this is going to lead to one of our trading ideas. Here is money flow. Rich world's job crisis jolts money flow to millions, and not just millions. How about to 800 million? So the article goes on. I'm going to see if I can get you the global impact. Here we go. This is about money from rich countries, from like the G7, the globe, the biggest, richest countries in the world, where people go from more emerging market countries and go there to work and send money back home. The Reuters, there's a part of the article that estimates that to be about 800 million people globally are counting on those remittances. So not only has COVID slowed the economies down in these poorer countries, but let's see here. Okay, I'm not going to find the easy numbers the easy numbers, but I have some of them memorized for you. So money flowing to Mexico, to Argentina, to Costa Rica, here in this hemisphere, and in the Philippines, to Bangladesh, to Pakistan, to India from other parts of the world flowing back into there. Those numbers are drastically falling, the amount of remittances flowing back to those places, hurting those economies even more. So if you're inclined, even though the market is pushing up, but you want to have some hedge on your portfolio, I suggest hedging, not in the S&P. Don't buy an S&P short to go against all of your U.S. stock longs. You might consider, let's go to a daily chart and look at the emerging markets, and let's see how they have been relative to the U.S. If we look at emerging markets and we pull up our Fibonacci retracement tool, let's look at the price retracement lines here, and we go from here down to the lows. Oh, to be fair, let's do it to be fair, because we've always gone from the February highs. So let's delete that one, and let's go from the February highs, as we've done with all kinds of companies who made their highs earlier. So we'll look at the same February time frame. So let's go to the February highs down to here, and we'll see the retracement that we've seen in the emerging markets is not as strong as it has been in the U.S. The U.S. will go back and look, but well above the 618 retracement. And here's another market that you might not know about. So you might be able to look at one of the inverse ETFs for the emerging markets, or just short the EEM. It's easily shortable if you would like to do that. But here's another one that you might look at, and the frontier markets have not done very well. Now, frontier markets are markets that could explode in the near term, and they separate things out, like they have Argentina, they have Vietnam, they have some even Middle Eastern exposure, Kuwait. But these are some countries that and markets that have not done as well even as the broader EEM. And part of the problem with the EEM, there are some Chinese companies in there that kind of make that a little bit messier as a true barometer. So you look here, this one has barely gotten up to the 382. So FM is the fund name, the Frontier 100, and it represents, they hold stock in a lot of companies in those frontier types of markets that I mentioned, could be used as a different type of hedge. Let's look at one other piece of news that's quite interesting, and then we'll get back and look at our lines and some trades, and I'll take some questions, and we'll hang around for a while this afternoon. Doing the once a week meetings now, so I don't have to get out of here right at the top of the hour. I never did before, as you well know. So I'll hang around, answer some of your questions. We'll look at some of your stocks together. But first, let's look at one other really intriguing chart, and let's see another reason why the recovery might not be as fast as some people are thinking. Here's a very interesting chart. This came out of Bloomberg, as you can see, from the BEA, Bureau of Economic Analysis. Bloomberg put it together. So for the 1 month, income increased when many people, those making up to $99,000 personal income, got the fiscal support checks, the stimulus checks. But look what happened. Income went up 10.5%, and spending did not follow. Now, to be fair, there weren't that many restaurants and other places to open, but that, I think, is good news. I think I look at that as good news. That some people saying, well, maybe the reopening, we won't be spending as much money as quickly, and that's for sure going to happen, people. That's just common sense. People are not going to run out and put themselves in harm's way to go out and have a meal or buy some clothing if they still believe that there's a chance that they could contract the virus while they're out. So there is going to be a slowness there. But what this does say is that there is some money that's out there to be spent. And that is a good thing for the economy, since the U.S. economy, roughly, depending on the study you look at, is driven about 60% by consumer spending. So a very interesting chart to think about moving forward. Now, We've got a couple more things on our PowerPoint. Let's actually go back and look and see what we wanted to talk about here. Today we have a couple of other things that we're going to touch on before we leave. We're going to look at our levels. So we've hit our emerging market remittances. So we can check that one off. Check, done that. All right, so now we're going to look at short-term levels, and then I've got a couple of trades to consider, and then hang around. I'll answer some of your questions. We'll talk about some of the stocks you want to look at, and even if you want to look at a little bit of dark pool data. For those of you who know that our Dark Edge project has launched, we had 200% winners that were booked just this morning in the Dark Edge trading room. So I hope you'll take a chance to look at that and what's going on with the Dark Edge project, and join me every morning live in the Dark Edge project. And in our Dark Edge trading room. So let's look at our short-term. Let's look at our short-term items to consider. Here we go. We have some levels that we have talked about nonstop. Here's the 618 retracement level. So from the highs in February to the lows of March 23rd, the retracement, it took us this fast, very quick to get up to to break through the 382, or about a third retracement. Here we battered around the 50% retracement, finally went up to the 618, or roughly 2/3 retracement. Then we battered around, as we talked about, we stayed in that box for about 6 weeks. Then we broke out and have stayed above it, and now we're trading up and making new highs. So we really haven't a good chance for new closing highs, let's say. We haven't gotten up to the peak that we made last Thursday, but we're getting up there and pushing it. So we're right at the top of the intermediate term page. What's going to tell where we're going from here? Where we're going from here is up until further notice. So every little pullback is to be bought. Where's a good place to buy a pullback? Well, it's pretty clear. This old level of resistance is going to now become support. If we trade down to this level, that is going to be the level X marks the spot. As we get down close to hitting that 618 retracement, as we get close to hitting this level where this, 2, 3, there's a 1 day, let's call it 2 day, 1 day, 2 days, 3 days, 4, 5, 6, 7, 8 days where this formed resistance, market wouldn't let it get through, all the way up to these levels where it came back. It's now formed support. Any trade back to that, I think, is a monstrous buy sign. So let's look at a couple of trades that are buy signals before then, and then I'll take a look at some of your questions and some of the things you'd like to talk about. Let's look at one that is a beaten down commodity that has recovered. And they often call copper, this is the ETF, the Exchange Traded Fund for Copper, they often call it the metal with the PhD in economics. And they call the copper that because often its turns predate the market turns. Market turns up or market turns down, because you need copper to do so many things in homes, for pipes and wiring, in cars and electronics. Copper is such a pervasively used metal in new construction and building stuff that's why it got that moniker of the metal with the PhD. And we see that it had a huge drop down along with the rest of the market, saying, yeah, nobody's going to be building anything. And then it's had this slow and easy build right back up to a very key, and I'll draw it back here, but a very key resistance level. It's trying to break above that resistance level, but a breakout of copper above about the 39% level could be very strong for this metal if you're looking for something to help to play a different way, an unusual way to play the economic recovery, the longer-term economic recovery. Some longer-term leaps if you're into that sort of thing for options, or just buying and holding the metal. So I like that idea and the strong channel that it's been in over the past few months. So with with that one. Let's talk about another one that I talked about in the Dark Edge project. And this is not a very optionable. The options are very very thinly traded, so it's difficult to trade the options. But if you're looking for a stock with a little bit of a dividend to put into your portfolio, here's one to think about, and it is Coresight Realty. Coresight, it does a lot like, they do some things just like one of our old friends we've talked about before, Digital Realty Corp. Digital is a company, and Cores, they both manage data centers for the big boys, and girls like Amazon, Microsoft, all the people that do cloud computing. They will build and manage the whole data center for these companies, so they don't have to hire employees to do that. So they don't have to hire people. They can contract it out to these big REITs that specialize in data centers. Now, Coresight is interesting because of its recent breakout. I want to show you this on a monthly chart. Let's pull this back to a monthly chart, and we could build a nice long rectangle that we've just broken out of right around the 122 level. If we go all the way back, I mean, you could look, if we wanted to watch this rectangle, we could probably go all the way back into here and pull it up and over, and we would see that this thing has been in a long, let's pull down our 122 line so we can get this exactly right. Horizontal line, there we go. Let's make it at 122. Look at that, I was about dead on with my rectangle, because it's all the tops of these things that have happened. As it's broken out now, and this breakout, remember, even though this is a monthly chart, this breakout was just one day last week, and now it's holding that. I like this to go, in general, if you looked at Shabacher or Edwards and McGee, Shabacher, Edwards and McGee, any of the classic charting pattern people, they would tell you you could take this and look at least this $30 rectangle and draw another 30 above it, so that you would go from about 122 to about 152. Plus, it's throwing off a nice little 2.5–3% dividend to boot. So I like this play as a longer-term breakout play, but unfortunately, you're going to have to look at the stock, or you're going to have to be extremely patient and put up with really wide spreads in the options, because it does have options, but they're not very thickly traded. So there's a couple of trade ideas for you going forward. Some background on what's going on in the world, some price levels to look at. I hope that was a full 33 minutes for you, even though we had to spend a couple of them getting our trading platform up and running again. But I will now turn my attention to your chat and look and see what you folks are thinking about. The other stock was JJC. JJC. It's the copper ETF right there. JJC. It's this is the monthly chart. So let's pull that back to a daily, especially if we want to look at anything for other people. The iPath's copper ETF. All right. Let's look at a few of your questions. Let's see here. The commercial space race, stocks to buy there. I mean, you look at, they're really SpaceX and Bezos's his efforts are really on privately held. So I don't have anything in my wheelhouse that would say, buy these for the new space race. And that's you got to have a long view there. You got to be looking out 10 years, probably more than 5, to be able to play those kinds of stocks, and even of the smaller stocks that are supporting them. Okay, 3,000 as a major support level. Before the 61, it seems like the market got even more bullish. Okay, George, I'm sure you're talking about the INX. So 3,000 is here, and 3,000. I've done it a couple of times. Extensive studies on whole numbers, and whole numbers are very real. And if we looked at it on the horizontal line here and put one at 3,000, yeah, it broke through there. But, there wasn't much happening here. Let's look back here. A little bit of activity, but see, it's chopping around. So to answer a question like that, George, what I would do is come back and look. We came up, and yeah, did it form support there, resistance there, and for a day or two there, but then it chopped around. It didn't break through cleanly. Here it hit and chopped around, didn't break through cleanly. Here it hit and chopped around and finally broke up through. So there's something happening there, George, but I don't believe that it's the key one for us to look at right now. I don't think that's what traders have their eyeballs on. I think they've got their eyeballs more on this level where we held here, broke through cleanly, came up, held. When we finally broke, we went through here. So that's why I think the little bit lower level may be a more important one. So it's an astute chart observation, though. Let's see here. What else? We had one of the others. Got the space race. What do you think of Amazon, Shopify, and Square? So that's a lot, Bitcoin, Preston. We could talk about Bitcoin, and you know it's up against an important, it's coming up to an important support resistance level here. So I know you can see we've got this probably this some sort of triangle formulating here. Is Bitcoin going to break out and go, or is it going to be find more resistance there? Stay tuned. But I know you have a couple of other. So I love Amazon for the long term. Buy it on pullbacks. I wouldn't buy the breakouts on Amazon. Every time you get a pullback like here down into the low 2300s, I add to your Amazon position. I own it personally. And I've been recommending it for years. On almost every pullback, I recommended it on Charles Payne's show in January when it was still really beaten down, when Apple and Microsoft and Facebook, everything was outperforming it. I said, nope, Amazon's going to be the way to go because it's underperforming in the stock, but not underperforming in the financials. And lo and behold, that has paid off. I continue to like Amazon. There you go. Bitcoin, Preston. What else do you had a couple of other quick ones? I know I like Square. Shopify, I think, is overdone. It could keep going to the moon, but I think it's overpriced. I think all the value of Shopify is priced in. To buy that on a pullback, you'd have to get hundreds of dollars worth of pullback to get me interested in that one. And Square, I really like, but you can see it's running up against some couple of key resistance levels here. So let's take a look there. We could probably draw one somewhere meaningfully right around in there. And then, of course, you got one just above with this little thing. Could this be a very, very long term? If we drew it on a monthly chart, could we begin forming a head and shoulders pattern? It's possible, but I love the payment space. People like Square, PayPal, the big boys, Visa and MasterCard. So the big companies, the big boys and girls, love them. I think they're going to be winners long term, but I think the smaller players, PayPal and Square, are going to be doing great. PayPal's Venmo and their other operations, they're just doing really well. We could pull them up, PYPL. They've had they had a pullback for a couple of days, and now they're breaking to new all-time highs today. So I love the payment space in general. Square's a good one. They're very pervasive. I think the one downside to Square is they have some exposure to small businesses. They made a great thrust into small business, especially payment systems for small retailers and small restaurants, and that could give them a little bit of lag time till they catch back up. All right, let's see. Who else do we have out there? Other questions? The airlines love, they had a big pop because of some good news over the weekend. I don't love them. I really don't love them. I think that we're going to go back and maybe even test these lows before everything's over. Here's a quick thesis. They're going to have to put fewer people on a plane. That means they have to charge more per seat to break even or to make money. That means that for all the people who aren't doing business travel and it's not critical to what they're doing, people who wanted to go see their brother out in Tucson, or who just wanted to spend a week in the Keys to get away from everything, or any of that travel, when you raise prices 20-30%, the one thing that we do know unequivocally about the airlines is that what matters to customers is not customer service. It's not anything else except price. People, we've taken away most food services, fewer amenities, all of that. People say we don't care as long as you give us a lower price. That's what every survey and looking at parsing every piece of data and seats sold in the airline industry tells us. So by having to crank prices up, I think it's not going to get there for the airlines very quickly. Do not like them, Sam. I am. And Warren Buffett's even popping out of his investments there. Let's see here. Okay, WRTC from Andre. Raptech, I do not know them very well. They used to trade 100,000 shares a day. Now they're trading 5 million shares a day because they've gone from 4 to 8. They've doubled in the past couple of weeks, and they've gone up from 5 to 8 in the past couple of days. What does Raptech do? Those aren't the folks that do car wraps, are they? Who was that? Andre? Was it Andre that sent that out there? Yeah. What do you zap in here and remind us what they do? Here's all I can tell you. I can look at this stock and I can give you one great piece of advice. We've gone up like this. We've gone up the one side of the Eiffel Tower. What's important to say, if you own this thing, if you got in on this rocket ship, good on you, first off. And where are you going to get out when it comes back? When, not if, when it comes back down the other side of the Eiffel Tower. Are you going to get out 7? You're going to get out, let's see, where are some logical levels? Right there, looks like one of them is 7. What about down here? It's 5.5. You got to pick some place to get out. Where's your get out point if you're already on this rocket ship? And unless they found a therapeutic cure for COVID, I'm not a buyer at 821, and I bet it's hard to borrow, if not possible at all. Oh, physical restraint. Cool. Got it. I understand. And with what's going on right now, if you're in it, Andre, get your get out point. Have your get out point. If you're not in it, I don't know that I love it right now, but I don't know enough about the fundamentals of the company and what they're doing. When big disruptions happen, like the tragedies we're seeing in cities all over right now, and what could be ongoing for a while, people look to see who can make a solution to help us with these things, and that's what's happening here. Let's see here. What else? What I'm trying to get most of them. Sergio, we talked about Zoom a little bit this morning. They are reporting tomorrow. They're reporting Tuesday after the close, and look, they've had a 12% pop. Now, the reason they had the pop was not because of yesterday, but was one thing. They broke through this. Key level, but they also announced another phase of their security upgrades. Remember the Zoom bombers that were breaking into their software and that caused this big drop. And I implored you back then, I begged you to buy it, buy Zoom on every pullback. They had a pullback here with the rest of the stay-at-home stocks, and we had the work-from-home stay-at-home stock pullback last week. Those pullbacks are all buyable on Zoom. I don't know that I love it here, and you can't really touch options right now if you don't own them already for earnings tomorrow. And most likely, although not for sure, many of the stocks out there like Netflix, like others that have had big run-ups on work-from-home, stay-at-home kind of premise, have been sell the news on the earnings. So I would be very wary about buying Zoom up here. Find a pullback zone to get involved in Zoom. I've checked the Zoom options. They're just outrageous. They're 100+% implied volatility on those. All right. There we go. Rolling up and out on SPY puts. My suggestion on SPY puts is to get the heck out. I wouldn't be in SPY puts right now. That might have been someone else's recommendation, so I don't want to step on anyone else's toes. But my near-term premise, if you heard earlier in the broadcast for Afternoon Outlook, is that until we figure out what kind of surge data we're going to get about 2 weeks from now, we won't get much at all until then. because we have to have time for people to be around each other, to spread the virus, and then to see how many people are going, how well we're going to act as a country, as a society. Are we going to go out and protect ourselves and others and do a good job of that, or are we not? We do not know that answer yet. You know, there have been pictures of really people doing the right things, social distancing, doing great things, and then we've seen people on boardwalks and beaches and parks and other places where they're just jammed in like sardines, no face coverings, no nothing. The jury's still out. But until then, I think we get a free ride to the upside because of all the stimulus money. That's the broad narrative that I'm going by. So do not like the puts. Jets or individual airlines. You know, take your pick. Jets may be a little less volatile if you want to play options, but I think the airlines, pick one. UAL's weak. They've all been weak long term, and they're all having a big snapback over some articles that came out in the last day or two, the last couple of days. Okay. All right. Designs, business enterprises, hospitals. Somebody was answering a question from before. Okay. So we got the bowler wrap people, Harbor City. To sell some call spreads on ZM. Georgia, it's not the worst idea. Manage your risk. Manage your risk, because Zoom could come out and they could make that announcement. They could make their earnings tomorrow, and they could do something that's unrelated to what I just said. They could come out and say, hey, we had one scenario, the sell in the news scenario. Hey, we added this many users. We added this many number of new business accounts. The revenues are up, 80% versus last quarter and 200% year over year, and that's great, and that's about where everybody expected them to be. If that's the case, they're going to go down. If they're about where everyone expected them to be and not a lot higher, then the stock will go down. If they come out and announce some completely new platform, something else, something we've been working on this, they did the security thing already today ahead of earnings, pretty interesting. But that's the only thing. Just if you're going to do that, do the spread so you manage your risk. You know what you're going to be doing there. I'm assuming you're talking about doing a bearish credit spread on the calls. That's my assumption based on what you said. Okay. All right. So there you go. Gold and silver. Sarah. Well, it's interesting because I like them both in the intermediate term, but here's the thing. Silver has been much stronger lately. Let's take a look let's see if we can find a cool chart here. If we can find our cool comparison chart, which should be right back here. There we go. Look at that. Like magic, let's pull up gold on the bottom since it's the incumbent. So there we've got gold on the bottom. We're going to put silver on the top. And you see what's happened lately. Gold was just winning. So when this goes down, that means the commodity on the top, or the item on the top, this case silver, is doing worse relative to gold, which was the case for a long time. However, since the bottom was about May 23rd for the market. So since that time, silver has been doing pretty well. And recently, it's been on a tear. Silver is the much stronger of the two. It's always the more speculative, the more risk on of the two metals. I like silver a lot on the breakout. I'll just tell you, I completely missed this breakout. I would have loved to have had a position on. I missed it, the big hop up. I was hoping we'd get a check back. We never did, so I didn't get to put any positions on in silver. I like it. I think up in here you can see we're starting to hit some resistance levels, right? If we look up above here, right where we are here across, we're starting to see some resistance levels. So, on breakout items like silver, you might not be able to find a pullback to buy. So if you love it, you just hold your nose and jump in now. But the gold to silver ratio was so out of whack. It was at 20-year highs, how the price of gold relative to silver. So it's really exploding there. Let's see, Christy, Ecolab merger with apathy. Yeah, I didn't even read about that, the merger today. I know we got some big block trades on Friday in the dark pools. Let's see here if we can erase some drawings. And I think this may be a good trader going forward. I like Ecolab. Oops, I keep calling it Echo. E-C-L. Ecolabs. There we go. So it looks like the market doesn't like the announcement. Actually, if they made that announcement today, they're down 1.5% with the market's up strongly. So So there we go. We're getting close. A lot of we're down to 220. We're 20 minutes over. We'll take a few more of these. Alan asks about gold and silver companies versus ETFs. That's a tough one. You might look at the indexes as opposed to individual companies. You buy a big Newmont or GOLD or any of the big companies. You can look at those. You can look at GDX for the miners. If you really want to be speculative, you can look at JGDX, the junior. So let's run through those. Newmont. So you can go with Newmont, who's had a big pullback with gold, and a lot of the miners have done that. Rand Gold, you see the different, Barrick, that you see the different companies look very similar. Probably the index will look kind of similar to that, and it's recovering a little bit. The junior golds. Okay, so I got it backwards. I got my J in the wrong place. They're outperforming because we've been a little bit risk on in the markets recently. I think that has less to do with gold and more to do with the markets, which is a little bit how the juniors play typically. So, if you got a long-term point of view, GLD is backed by gold, so that's good. You want to play, a really speculative play, and you want to do something like NUGT, the gold miners. Why is it down so much? Just because of the nature of doing a 3X. If you want to make a long-term play, you really can't hang on to NUGT for a long-term player in the gold markets. It's a 3X levered ETF. But if you have a couple of weeks to a month point of view, you might be able to play something like Nugget, not more than 2 or 3 months at all for sure, because you get these kind of, you get this just general degradation in maintaining that levered ETF. It's built to mimic the GDX day to day, not over long periods of time. All right. Yeah, so GLD has to be backed by, has gold reserves as well, Craig. I don't know too much about CEF, so we'll pull it up since you mentioned her. Let's throw it up there, see what it says. Yeah, there it is at the top. Sprott. Ah, yes. My good friend. Yes, my good friends out at Sprott, including Rick Rule. So Rick and I have known Rick for at least 18 years. No. Yeah, about 18 years. So we go back a long time. So there we go. So we got lots going on in the markets. I really do think that we still have somewhat of a carte blanche in terms of, you look at all the negative news that has been thrown at the equities markets, and they just take every body blow and then just keep right going higher. I think you've got to respect that and stay on the long side as long as we stay above our new short to intermediate term line in the sand, which is not this one. That was one suggested. I'll pop that one off there. We want to keep looking at this 2940-ish range as a place. Market above that, bullish, buy pullbacks as long as we stay above that line so that you can use all that Fed and congressional stimulus in your favor for your portfolio. For the afternoon outlook, this is D.R. Barton Jr. wishing you a great rest of your day. Hope you had a great time here this afternoon. If you did, leave a few notes in the comments. I will stick around after we shut down the live stream, type a few notes in the comments for you. We'll do a little bit of that, and then we will see you right here, same bat time, same bat channel, next Monday at 1:30. So everybody, have a great rest of your week. Stay safe out there. God bless you.